Building on the P&L, we're now going to look at your customers' value drivers. And that's going to help you to go and engage executives at a more senior level, talking around a dialogue which is more familiar to them. So we're going to take the income statement and we're going to take the balance sheet and we're going to bring them together into a value driver tree, simple framework where we've got the strengths and weaknesses so that you can take a look at where your customer is in pain and where they have urgency and where they perhaps might be outperforming the competition. So let me go back to one of the reasons why is this important to you. So about a couple of years ago, I was working with an SVP of sales who was training his team around these topics around value drivers. And after explaining the topic of value drivers to them, he suddenly had a light bulb moment and he realized that 30% of their pipeline was currently filled with a specific solution which had no pain and urgency with their customers. And it was a bit of a startling reaction because they had never ever considered as part of their pipeline how any one of those deals could actually have an impact on their customers. They thought about the deal size and they talked about the close dates, but did they know whether or not it actually had that pain and urgency with their customers? So I give you that anecdote just so you have a think about what are the deals in your current pipeline today and look at, do they actually have pain and urgency on your clients and your customers' biggest value drivers? If they don't, great opportunity for you to reassess, potentially expand the deal size into an area where they are actually looking for bigger challenges to solve in their business. So I'm going to start with a very practical setup. I'm sure many of you are familiar with stock price charts. Let's take a look at that one for Starbucks. So as we look at the stock price over the last few years, actually, this looks like it's going pretty well for Starbucks. There was a bit of a blip due to the pandemic, but actually their stock price is outperforming peers. Said another way, if you had put $100 into Starbucks a year ago, it would be worth roughly $150 today. So it's gone up by about 50%. That's a great result. But the question is, why did it go up? Have people started returning to their stores quicker than they were expecting? What's been going on with Starbucks overall? Well, to understand that, we have to think about investor expectations. So investors are expecting that Starbucks are going to generate more cash in the future than they are today. So they are going to be always thinking about, can that free cash flow in their business, can it amplify for them going forward? So to make this example practical, why don't we think about an individual A who's got a high net worth and relatively low debt, and you've got an individual B who's got a relatively low wage and quite a few debts. Who do you think's more creditworthy? Well, in the eyes of credit agencies, the first person would be, because they're more likely to be able to pay back their debts if they were to take out a loan for a car or something like that than the second person. So when you think about how investors are rating stocks and companies, what they're thinking about is something similar to that creditworthiness. Is it likely that this company, if I put my money into it, will they generate more cash in the future than they have done today? And if the answer is yes to that, stock price goes up. If the answer is I'm not so sure about it, stock price stays flat. If the answer is I'm probably not expecting more cash in the future, stock price goes down. That's a very simple way to think about how companies and how investors are actually valuing different businesses through their stock price. The cash flow is what is most important to them. Now, where does that cash flow come from? First, it comes from revenue. If you aren't bringing sales in the door, then you aren't going to bring more cash. So we saw the concepts earlier around revenue growth for Starbucks. We saw that they were bringing a lot of beverages and foods business into their stores during the normal year, but their channel sales not doing so great. So channel sales is an area for performance improvement, but that's the revenue growth. That's a critical part of the value drivers. Next, we look at the spread. I'll only mention the spread once. You won't need to worry about it too much. That's the difference between the returns on invested capital and the weighted average cost of capital. Just think about that in terms of if you're giving money to an individual to go and invest, are they returning more than they were? Generally, most large organizations by this point are doing that. But in certain circumstances, that's not the case and companies could be negative on the spread. If they're growing revenues with a negative spread, that's called value destruction. When we think about the core components of the overall returns of invested capital, it's basically going to be the operating expenses of the business, the profitability overall. And we're thinking about the gross margins and the SG&A efficiency that we saw in module 1. And What we also have is then the balance sheet, the capital efficiency. So we're thinking about how is this company taking the assets on their balance sheet, and are they actually generating more returns from those assets? So those are the three major components of the returns on invested capital. There's the gross margins, there's the SG&A efficiency, and then there's the working capital, or what we also call the cash conversion cycle. And this is really to understand, is the company taking cash, generating more cash in a faster time period than they were previously? You want that cash conversion cycle to be as low as possible. So when we think about future expectations with investors, they're thinking about cash flow in the future, or the actual official word is free cash flow, FCF. And when we look at some of the charts here for Starbucks historically versus the future, you can see that investors have got high expectations for Starbucks in terms of generating more free cash flows in their business over the next 3 years. That's the main reason why the stock price is going up. The final value driver is risk. And each company has their own types of risks. There may be cyber risk, maybe operational risks, might be market risks, credit risks. Depending on the company and their industry, there are different types of risks. Now, those risks are sometimes intangible to the business. It's hard to go and tell what those risks are and when they might occur. But that is a key value driver for a lot of organizations, making sure they minimize the risks and have a clear action plan of what will happen and what they will do if any of those risks occur. So I'm going to go back to the example of companies that are not doing well, that are destroying value and are trying to grow at the same time. You may remember for Kodak, or you may remember Radio Shack. These were companies doing really, really well, but unfortunately, they just didn't make the right investments into their business at the right time, and they went bankrupt. And the key here is, how can you help your customers to do exactly the opposite, to grow their business, to be able to improve the efficiencies overall so that they are creating value and amplifying that through their top line. That's the goal of enterprise sales, to help create those funding events with your customers, engaging them at the executive level, talking about how you can help them to go create value is going to then drive value for you and for your company. Okay, so now we've got the fundamental value driver tree and the framework for how every company makes money. Now what we can do is we can overlay onto that the relative strengths and weaknesses. So similar to module 1, where we saw some of the trend lines and some of the comparisons with the competition, this information is now available to you in real time for every company on demand. What you can see is actually for Starbucks, their revenue growth is underperforming, their gross margins are underperforming, their capital efficiency is underperforming. There's actually quite a few areas for underperformance here. Those are starting to help us to narrow in where there may be some more pain and urgency. The key buying groups that are going to be important and responsible and accountable for addressing these are going to be sales, it's going to be the marketing on the top line growth, channel sales in particular, because that business segment's underperforming, supply chain, procurement and sourcing, finance. There's quite a few different buying groups, which is great because as a seller now, if I'm thinking about going after Starbucks, I've got a lot of different avenues to go after. The types of solutions that they're looking for are going to be things related to the customer experience and improving that to drive more revenue, their channel sales development, their pricing optimization, their logistics and their demand, how they can improve the supply chain. There's a number of areas here which are going to be super helpful to go and engage executives on Starbucks' biggest challenges. Now, just remember, all of these companies are living organisms. Their businesses are changing quarter over quarter, month over month, day over day. And keeping a track of how your customer is doing overall is really important. Your customers are changing their business, the competition are investing into their business, and you can help them to go and outperform going forward by addressing their strengths and weaknesses, and in particular, identifying pain and urgency with your solutions. So that's the value driver framework, and hopefully you now have a better understanding of where pain and urgency can be found with your customer. Next up, we're going to talk about management incentives and executive compensation. And that's going to strike right at the heart of how those metrics are going to be important, and so you can go and engage with confidence. As one of my former bosses used to say to me, he says, "Hey Anand, now I've given you the keys to the Cadillac." Hopefully I've done the same here with you. You now have the recipe for understanding how every company has pain and urgency and where to focus on their business.